Hey everyone, when it comes to creating wealth in stock market, you need to identify three things. First, what are the fundamentals of the company? Second, how is the future growth prospect of the company? And third, how is the valuation of the company? All three parameters are equally important. For instance, even if the company is fundamentally strong and has a bright future prospect, but if the valuation is too high, it can't really create wealth for its investor. Hence, valuation plays a very important role while investing in stock market. And that's where majority of investors make mistake. A lot of novice investors think that if a stock is available at lower price, then it is cheaper than stock available at higher price. For example, if a stock A is available at 100 rupee and stock B is available at 1000 rupee, then stock A is cheaper than stock B. And honestly, I've come across a lot of people who believe that lower stock price means cheaper. That is the reason a lot of people want to invest in penny stocks that are available at very low cost of say 5 rupee or 10 rupee, because they think that a stock at rupees 10 can quickly double to rupees 20 as compared to time stock at rupees 100 will take to become 200 rupee. And likewise, a stock at rupees 100 will take less time to double as compared to a stock at rupees 1000. Again, a major blunder. You can't look at stock price to decide the valuation. For instance, today MRF is trading at 97,000 rupee. Another tire company, Apollo Tire, is trading at 365. So in terms of share price, MRF is 265 times of Apollo Tire. But it doesn't mean MRF is 265 times costlier than Apollo. So in this video, we'll learn how to identify the true value of a stock. This will help you understand whether a stock is overvalued or undervalued. And obviously, as a long-term investor, you would like to invest in undervalued stocks that can potentially generate great return and avoid overvalued stocks that can destroy your wealth. But before we proceed, this video is only for long-term fundamental investors and not for traders. Alright, let's get started. So there are 6 key ratios to identify valuation. PE ratio, PS ratio, that is price to sale, price to book, EV to EBITDA, DCF and PEG. We'll first try to understand these 6 ratios and their meaning, and then we'll dig deep into the most important ratio, that is PE ratio, to really understand the game of valuation. So first is PE ratio. This is by far the most popular KPI to measure the valuation of the company. PE ratio signifies price to earning ratio. It basically means how much money you are willing to pay for one share of the company that generates 1 rupee of profit. For example, today TCS is available at a PE ratio of 28. Now, how do you calculate this PE ratio? By simply dividing the price per share with earning per share. Price per share is nothing but the actual share price of the company. In case of TCS, price per share at the time of creating this video is 3,219, and earning per share is calculated by dividing 1 year of profit with total shares of TCS. You can even find this information directly on tools like Screener. Here TCS trailing 12-month earning per share is 115.19. So PE is calculated as market price divided by EPS. So 3,219 divided by 115, which is 27.9. That's what is shown on Screener tool. In fact, you can also calculate PE ratio by simply dividing the market cap of the company with its last 1 year of total profit. For example, TCS has a market cap of 11.77 lakh crore and total profit of around 42,300 crore in last 1 year. So its PE ratio is 27.9. That's same as what we have calculated earlier. The only difference is that in first case, we calculated PE with 1 share, whereas in second case, we calculated PE for total shares of company. That's essentially the same thing. Now the catch here is that this PE ratio keeps changing every second during the active trading hours based on the change in the share price of the company. So let's say tomorrow TCS share price becomes 3,500, then its PE ratio will change to 30.38. And if its share price becomes 2,800, then its PE will change to 24.3. This PE ratio will also change based on the quarterly results. Now, generally speaking, a low PE ratio means stock is undervalued and high PE means stock is overvalued. But it is not that simple. So the big question here is, how do you know if TCS current PE ratio of 28 suggests whether TCS is overvalued or undervalued? Just hold on to this thought. We'll cover it in the later part of this video. Then second important KPI is price to sale. It is calculated by dividing market cap of the company with last 1 year of revenue. Or by dividing price per share with revenue per share. Both are same. For example, in case of TCS, it has a market cap of 11.77 lakh crore and 1 year revenue of 2.25 lakh crore. That means TCS has a price to sale of 5.2. This KPI is mainly used when a company has a volatile earning or if the earnings are negative. For example, in case of Tata Motors, it has made a loss of 3,798 crore in last 1 year. So you can't have PE ratio for Tata Motors. That's where you can look at price to sale, which in case of Tata Motor is 0.54. Just for comparison, Maruti Suzuki has a price to sale of 2.2. So currently Tata Motor is available at 1/4 valuation of Maruti in terms of price to sale. Price to sale is also useful to identify the valuation of new age companies that are in losses or high growth companies. For example, Zomato has a loss of 1,098 crore in FY22. So again, you can't have PE ratio for Zomato. In that case, you can look at its price to sale. Again, the same question. How do you know if a price to sale of 5 or 10 is cheap or expensive? We'll look at it in the later part of this video. Then third KPI is price to book value. Price to book value compares a company's market cap to its book value. It is calculated by dividing market cap of the company by its book value, that is total asset minus total liability. Price to book value ratio indicates how much investors are willing to pay for each rupee of company's book value. This ratio generally used to evaluate companies and industries that rely heavily on tangible assets such as your manufacturing, transportation, real estate, and even for banking sector, price to book value is a major KPI to gauge the valuation. Then fourth KPI is EV to EBITDA. It compares company's enterprise value to its earnings before interest, tax, depreciation and amortization, which is EBITDA. So enterprise value is a measure of company's total value including its equity, debt and cash equivalent. And EBITDA is a measure of company's operating performance. Enterprise value is calculated by adding a company's market cap, total debt, minority interest and preferred stock minus its cash and cash equivalent. And EBITDA is calculated by adding company's earning before interest, tax, depreciation and amortization. Again, you can find this information on screen now. Now, fifth KPI is DCF, that is discounted cash flow. It is also one of the most popular way to calculate the valuation of the company. DCF model is based on the idea that a company's value is determined by how well the company can generate cash flow for its investor, because essentially a company's value is nothing but the sum total of all the future cash flow discounted to their present value. Unfortunately, the calculation with DCF method is a bit complicated and time taking, so not very useful for normal retail investor. Moreover, DCF method is also not a foolproof method of gauging valuation because this method also takes certain assumptions while calculating the future cash flow. In case you want to learn more about DCF method, you can explore it yourself. I also have covered it in my online course on stock fundamental analysis. Then final KPI is PEG. PEG is calculated by dividing price to earning ratio against company's future earning per share growth rate. Here the key is future earning, and hence you need to know what is the earning a company can make in the future. And when I say future earning, I mean next 1 to 3 years of earning growth potential. This is a very good parameter to gauge the valuation of a company because a high PE ratio doesn't always mean that a stock is expensive. Likewise, a low PE ratio doesn't always mean that a stock is cheap. For instance, if a stock A has a PE ratio of 50 and let's say in the next 1 year, its EPS growth potential is 40%. So its PEG ratio would be 50 by 40, that is 1.25. Now let's say stock B has a PE ratio of 10 and its EPS growth potential in next 1 year is 5%. Then its PEG ratio would be 10 divided by 5, which is 2. Now which is cheaper, stock A or stock B? If you look at PE ratio, stock A would be way more expensive. However, PEG ratio suggests that stock A is relatively cheaper than stock B because its earning growth potential is much higher than stock B. Generally speaking, a PEG ratio of 1.5 or less signifies stock is undervalued. Anything higher than 1.5 means expensive valuation, although there are exceptions. Now, unfortunately, you don't find a right PEG ratio on online screening tools because it is not possible to gauge future earning potential with 100% conviction. Although you can find PEG ratio on screener, but I don't trust the data. So you need to do your own research to identify future earning growth potential to calculate PEG ratio. So these are the 6 important ratios to gauge the valuation of a company: PE, PS, PB, EV to EBITDA, DCF and PEG. Now let us deep dive into PE ratio to really understand how to identify if a stock is undervalued or overvalued.